Okay. Okay. Well, hello everybody. My name's John Dougery. I'm with Inventus Capital here with my partner Manu and Brian Solomon from Forbes. Um, I guess I'll just give you a brief introduction about Inventus. We're an early stage venture firm that backs entrepreneurs both in Silicon Valley and in India. So half our team is here in Menlo Park in Silicon Valley, and the other half's in Bangalore. And we've been backing the entrepreneurial community between both countries for the last 20 years, last almost 10 years as Inventus. We manage two different funds, have over 30 active companies, and have seen a lot of success in companies addressing either the Indian or global markets from both Silicon Valley and India. And we're here today to share some of those experiences with the help of Brian leading the way. And we'd encourage you all to submit your own questions. We'd like to interact with you as much as possible as well. So, Brian, with that, I hand it over to you.
Great. Yeah, well, welcome everyone. As John said, I guess you write your questions in and suggestions and questions down below, and we'll chat, and I'll ask some questions for a little bit, and then we'll start taking some of those viewer questions, I suppose, as you submit them. So get those up in there, and we will take your questions soon. But I want to start by thank you for having me, and I want to start by start a little broad, and let's talk about the marketplace for funding in general. I mean, I think so much has been written and so much has been talked about. The marketplace right now, bubble or not, things seem to be going, pretty swimmingly. So, from your perspective across the world in different places, I mean, what do you think about the funding marketplace right now? Is it too easy to get money, or is this a great time for entrepreneurs? What's the general thought in your offices?
I'll jump in, and Manu can also share his thoughts. I think it's a great time to be an entrepreneur. Probably hasn't been a better time for two reasons. I think the amount of capital it takes to start a company is as low as it's ever been, and the access to that capital is as high as it's ever been. Um, so from a capital raising point of view and getting the resources from that perspective, I think it's a great time to start a company. Um, I think challenge though is really structuring and getting the right investors around your company. Um, I think there's a lot of talk about that, at least in the circles here in Silicon Valley and in India too, to a certain extent, um, because you're really looking for, you know, differentiated capital. Most successful startups are backed by very active investors who provide long-term support. And there are a lot of new investors coming into the market now with a lot of excitement and belief about what digital services can do to disrupt all sorts of businesses. And they want to come in and back entrepreneurs, but they haven't done it before. And so, one of the things we try and suggest to entrepreneurs is that they, in this environment, do have a choice, more choice than they probably have ever had, and they should exercise that choice carefully in picking the right set of investors, particularly at the earliest stage when all the foundations of the company are being set.
Yeah, and I'll take a little bit of a contrarian view as well. I mean, I agree with what John said, but having been an entrepreneur before, I think that one of the best times to start a company is when there's blood on the street, right? That means you can hire people easier. For example, when the market crashed in 2008, I quit Google a couple months later because it was easy to find everything from real estate, so I can get cheaper leases, to hiring employees. And I think when you have a good idea, it's harder because there's less capital, but there's always capital for good ideas, right? But the good thing is you don't have the immense amount of competition and every other incubator spinning out the same idea 10 times over. So you have room to actually get a lot further with the money you raise and hire the team and be able to scale. So so I think for good ideas, you shouldn't wait. I think if you have an amazing idea and you have the team and you have the expertise, the time is today. Don't wait until the next boom cycle happens or the next bust cycle happens. I would say do it today because there's no other time like today, right?
That makes sense. Is there, when you say that it may have been easier, to start things in a down cycle, does that mean at this point, even though the advice is go out and start whenever you have a great idea, does that mean that right now when things are flush capital-wise, it may be more difficult to do some of those other things because potentially there's so much competition and while the funding may be up, as you alluded to, the expenses may be up as well. How do you balance that when you're an entrepreneur?
I'll take that. I mean, it doesn't, as a good entrepreneur, these are all challenges, right? So in a downturn, you have a different set of challenges you have to overcome. In an upturn, dealing with more competition, and so you need to find the way that your idea, your technology, your sort of product market fit, and your go-to-market is unique, and you can have a differentiation, right? So if you want to reduce the cost of scaling by hiring engineers, well, if you have the skill sets of hiring those engineers in India and you can have the same quality and upkeep, you have a much better cost advantage. Or you need to be able to, for example, if you have a service heavy business and you can have people in India sort of take care of some of those pieces, you can scale faster and better than some of your peers in Silicon Valley, right? So you have this hybrid model where you're leveraging core competencies from around the globe. So it all depends on the skill sets you bring in, but the best entrepreneurs find ways, to not look at challenges, but as a way of looking at opportunities you can sort of overcome.
Makes sense. And John,
I'd echo that. I think that you've got to be honest with yourself about how differentiated your idea is and your approach to that idea. In this kind of environment, because there will be so many other people that can fast follow, see your idea, get access to capital, and come after it, right? So you need to really be honest with yourself as an entrepreneur before you take the capital and really before you invest your career, the next step in your career, and going to build this to be sure that you're really onto something unique.
But Ron, I could give you an example to sort of drive this home as well. So one of the companies, Poshmark, we had an idea around peer-to-peer fashion, used fashion sale, and also boutiques, and they had the unique sort of value, that women shop very differently, and the way they built the underlying social layer was very different. But because they were taking off well, they actually got quite a few fast followers, ThreadUp, RealReal, with slightly different models, but some of them actually literally copied them pixel by pixel, right? But and they were able to raise substantial amount of money as well, the competitors that actually copying them. But understanding what it takes to drive that business and underlying metrics and KPIs allowed him to sort of really, sort of separate himself from the herd, right? And so you may copy what you see on the surface, but it's really hard to copy what's underneath, and that's why you build a differentiated sort of stack. If that makes sense, and it's almost flattering, right? If you are ahead of the curve and you can figure out and work your way, and you understand the unique value proposition you bring to the consumer, having other people copy you is actually flattery from that matter, right? And I think the best entrepreneurs find ways to succeed where others might actually get frustrated.
So finding the silver lining in that potentially bad circumstance is something that you would say, perhaps in this scenario where there may be copycats, but also in other scenarios, is pretty essential.
Yeah, I mean, perseverance is a huge trait that entrepreneur needs to have. Solving problems. You always get challenges, right? The key is, do I jump over that hurdle, go around it, break through it? So you need to find whatever it takes to win, right? And the best ones don't get frustrated because when you have the up days, the down days are coming. You just need to figure out how to keep the team motivated and excited to win.
Right. What do you guys look for? So you focus on early stage investments, early stage companies. What are the things? Is there a checklist? And if there is one, what are the things that are on the top of the list? The things that sort of you have to have, if you're investing in a company, and if you don't have that, I kind of rule them out right away.
John, do you want to take that?
Yeah, there's definitely a list that we have in our heads. It's not formulaic, but there are things that we're looking for and would like to see, and Manu hinted at one of them, which is this kind of endurance capability and this commitment. And everybody can talk about it in a pitch meeting, right? But we prefer to actually see it in action. In this environment, it's more difficult because companies are getting funded very quickly. But in the traditional kind of more normalized venture environment, you generally have to bootstrap a bit and get things spun up on your own with some friends and family money, which we love to see. I mean, that's even more, there's a lot more commitment now that you've got your friends or family involved, right? And so you like to see that, the team has come together and endured, not for the sake of suffering, right? But for the sake of really proving that you've got that conviction. And so we look for all sorts of indicators of that conviction. We also like to be surprised. I mean, the most interesting opportunities from our point of view are ones that are kind of orthogonal or, take another view of the world that, we haven't thought of and haven't heard about before. And so you're looking for that kind of surprising insight. So, some firms that are early stage are very thesis driven. They say, hey, we're going to do vertical software as a service for whatever, for the pharmaceutical industry or for the automotive industry or what have you. And they're looking for companies that are doing that. We definitely have some themes, but we prefer to also not put our blinders on and to have people come in and really surprise us about an insight that they've had from hopefully some experience in a given industry or a given type of technology and how it could be applied in a new way. And so that's one of the things we're always looking for in a team, in the element of a new company.
Yeah, and just to add to what John said, right, in terms of some of the other traits we look for, is sort of the intellectual honesty within the team, right? Have they really thought of the problem inside out? If product market fit is more important than early revenue, there are indications of whether there's a pain that you're trying to solve, right? So, but a lot of it comes down to the individual, right? We like teams, founding teams, at least 2 people. 3 gets to be crowd, but 1 is very lonely. 2 is actually a good section, and people who actually can understand there's a multivariate problem, and you need to be able to look at this holistically and tell a story, right? So this is no different than a producer or director in Hollywood actually telling a story, right? You need to be able to come in. It's not just a bunch of slides and stats, but it's the passion behind the entrepreneur, right? And so we look at sort of a bunch of personality traits that sort of say, hey, when it does get tough, and it always will get tough at some point, do they have what it takes to actually stay as a team together and win, right? So all those things, and sometimes these things you can't suss them out in the first meeting, as John was sort of alluding to, right? You want to get to know. It's almost like dating, right? You don't want to marry the first girl you meet, right? And the first girl you met at a bar. So you want to be able to, and this is more important for the entrepreneurs to sort of say, the co-founder you found is not somebody you just met, at 1 or 2 at a founding dating site, but you get to know the person because you're going to spend more time with that person than your girlfriend or your spouse. And similar to your board, you want to have somebody on your board that's not just bringing money in, but is adding value, has pattern recognition in what you're doing, so they can help you through that journey as well. So, so spend the time, because doing it right and doing it right up front is very important.
Right. When you talk about having that money from friends and family and bootstrapping and some of the things that maybe entrepreneurs aren't needing to do quite so much in this environment, how important is it to you that entrepreneurs really have skin in the game? I mean, we've seen some recent talk about entrepreneurs who are starting up and they're asking for money, and part of their idea of how they're going to spend that money is more salary for themselves and the other founders. Or we've seen the recent example of Secret, which went under, and there was lots of talk about how they took money out in their previous funding round. So how important is it to you that, especially at that early stage, that the entrepreneurs you invest in are really in it for the long term and not just looking to take maybe any money right away?
Right. I'll take that. It's extremely important, and it's extremely difficult in this environment for the investor to assess that. More difficult than it has been traditionally. I don't believe that the keys to success in building a startup have changed. This environment has changed from where it was 5 years ago, but the you know the foundation of what it takes and how long it takes, it, it's quick. Sure, you can build. Look at Slack. You can look at some companies that have just exploded out of the gate, but they're the exceptions. They don't prove the rule. The rule is generally that it takes you several years, often 8 to 10 years, to get to an IPO-able company, which is the type of company we're looking for. That doesn't say that there aren't projects that people could pursue that could be quick acquisitions, quick flips. But that's just not for our DNA. Those aren't the type of projects we want to work on. We're looking for, we want to build companies, and we want to look for founders who want to build companies. And so generally, when you have that mindset, you still have respect for the capital, and you think about, every dollar I take is still dilution to my ownership of this ultimately big company that I plan to build. And so, we look for guys that they're themselves. We don't have to have a hard discussion. Themselves are saying, yeah, I'm going to take a reasonable salary. I got to keep my family, in some level of comfort. I can't have stress at home when I've got so much stress on the front lines of a startup. We understand that. And so you got to take a living wage, but hey, do you need to be driving Ferraris and doing all that stuff? If you want the rewards up front, that's helpful for us that you let us know that, because then we know that we're just not a good match for you. I don't think those things change. The amount of money going into the system has definitely changed. A lot more money in every round. No one can decide what a seed or a Series A or Series B really is anymore from a size of the round point of view, but the stage of the companies hasn't changed. They're either in the development stage, early revenue, and so forth. And the capital markets are cyclical. I don't believe that this is a secular change in how companies are going to be financed and built over time. And so it would be an unnecessary risk to pile on top of starting a company to assume that access to unlimited amounts of capital is going to continue for the rest of our lives, and so unless the life of that company. And so if you can get the capital now, that's great. We have a lot of companies we have a company that's the leading marketplace for insurance products in India for consumer insurance, and they've raised nearly $70 million in the last 12 months, but they haven't yet touched a penny of it because they're already doing so well. So they've raised it because it's available, but that doesn't mean they're going out and spending it like drunken sailors, right? And we love that, So they're saying, hey, they're methodically planning how they're going to invest that, not spend it, and build a much bigger company faster. And in this environment, that's how we believe you got to think about it.
Are there, we talk about things that you were looking for, are there things that are immediate turnoffs for you when you talk to an entrepreneur who you might invest in? Are there things that when somebody walks in the room or somebody starts going through their deck that you say, oh, this is not going to be for us?
There are a lot of intangibles. Our firm, we're all about the entrepreneur. And everybody says that, but I mean, in terms of our investment thesis, like I said, we may have themes or industries or types of businesses that we prefer to look at, but in the end, the thing that really gets us to write the check and take the leap of faith is the entrepreneur. And so it's a personality fit. And if you see an entrepreneur that, is, Manu had mentioned some of the traits. Another of the traits we look for in an entrepreneur is a spirit of fairness. So you do want to see a team of one or two founders, and you want to see, hopefully another set of early employees under that, and you want to see a fair split of the equity that they've decided on, right? Not that we've forced on them, but that they've decided, and it's fairly split, so that and again, it's an indication that they're taking a long-term view, and they don't want those people to leave. In this environment, there's a lot of people hopping around, especially if you're in San Francisco. You walk down the street, you get recruited, and everybody's hopping to the next hot thing. You don't tend to do that if you have a significant stake in your hot thing, and or you do it less, right? So these are just, and so that kind of thinking that's innate and it's already there. It doesn't have to be, you know, just it walks in the door with the entrepreneur. That kind of thinking. That's what we're looking for. One example.
Well, I mean, just to add to what John said, I mean, one of the things we look at is how energetic the entrepreneur is, right? I mean, you want to be able to liven people around you, so their source of strength and energy, and if you're coming and pitching and you're drawing away and you're not really, I mean, the excitement sort of pour from every part of your body, right?
Yeah.
And if one of the partners is falling asleep, that's a bad sign, right? Or you end up texting, checking your email or doing something else, and I think which is a sign whether you're going to be able to convince your spouse or convince your mom or convince your co-founder to actually leave their job and join you. So being a CEO or a founder is a constant sales job, right? And when you're coming into the room, you're telling a story, you want to captivate, you want to be able to rehearse it. It's it is showtime in that sense, right? So you need to be able to sort of come in and sort of say, how do I convince these these 2 or 3 people in front of me to be able to give me what I need, right? And above all things, you need to sell, right? And I think and we want to be wowed. I mean, we're waiting to watch a really good movie sort of unfold, right? And you need to have a good beginning, a middle, tell me, and then finish it off well as well, right? Other pet peeves, is walking sort of said, I have no competition, or not understanding what landscape you're working in, or not understanding the size of the market you're playing into. Just hoping that based on your credentials, somebody will just give you a check, right? So you still have to, have really thought through and be honest with yourself and have that intellectual honesty in what you're building, right? Just because you have been successful in the past, you maybe had an exit in the previous company, doesn't mean this next one will be successful, and you can't skip all the pieces in between, right? So you still need to build a company, you still need to have the initial product market fit, and you can't sort of say, hey, I assume all the success will happen because I've done it before. So sometimes egos can come in the way of really having thought through the problem, right? So, I mean, we're betting on horses. We're betting on, we want to take, because, no matter how big our egos are, and lots of VCs have big egos, we know in our hearts that 95% or 99% of the success is actually betting on the right horse, right? So we want to make sure the person we're betting and the team we're betting is the right one.
Right. That makes a lot of sense. I just want to remind our viewers that they can ask questions down below, and I can keep asking questions. I got plenty of questions, but hopefully you guys, I think I see one question down there, but keep on filling them up, and we'll get to them shortly too. But so one thing you guys have, you guys are investing early stage, and talk about things that you want and things and perseverance and all that kind of stuff. But these days, how important, especially in this market, is it to you that a company reaches profitability in any kind of time frame? I mean, that's something that a lot of companies have foregone in recent days, and have gone really for growth and have gone really because the money is there to allow them to do such things that perhaps they couldn't do before. But do you encourage, early stage companies to really make that map to profitability? How soon do you want them to get there? What kind of talks do you have with your entrepreneurs about profitability?
Yeah, I can take this, and John can add more. But we, focus initially on unit economics proof points, right? So it's not about, I mean, if you get profitability at a low market share, you're not going to build a large company, right? And if you are spending like drunken sailors without any idea on how the business model will ever work, that's the other end of the spectrum that doesn't work either, right? So proving out, unit economics in a certain area. So if you're a marketplace sort of saying, hey, before, I scale to everywhere in the world, can I prove, San Francisco Bay Area or New York City or something, and sort of say, I understand what it takes. And I may have to spend money up front to be able to build that traction of unit economics. But, once I have figured this out, then I'm scaling it, knowing that I may be unprofitable for foreseeable future. But I can always turn that faucet off if the markets get tough, and I can get to profitability quickly, right? I mean, Amazon didn't get profitable until recently, but they could always do that, right? I mean, they had to stop spending on capex, and that was a quick turnaround to profitability. So looking at the underlying KPIs and unit economics, I think we really push our companies to focus on those metrics more than anything else.
Yeah, just to add, I mean, Manu made exactly the right point. It's the unit model, the business model, not the aggregate profitable model. And when to go profitable? When you have big market share, and you think that, it's the classic marginal utility curve, right? When you think that extra investment of dollars for growth isn't going to give you a very good return, and then you start to cash flow the business. And so that's why, if you go back to some things we look for, the fundamentals, if and you're honest with yourself about what the true size of the addressable market is and how accessible it is to grab that market, that will help you, right? Some people will say, well, I'm working in they'll just assume they're in a multi-billion-dollar market, but when you go and do the numbers, you find out, well, it's actually a couple hundred recurring annually. And so if that was the case, maybe at 50 or 60 million of that, unless it starts to expand dramatically, and hopefully it does, then you might want to think about, making the model, throw off some cash. But if it's a $40 billion or, multi-billion-dollar market, then yeah, maybe you can continue. And that's generally what's happening. I think that, we're seeing a lot of money go into some of these companies, billions of dollars in aggregate venture capital, and that's because they do have a proven unit model, as Manu mentioned, and they're going after these monster markets. And until the model breaks, until that growth model breaks, they're making the right choice to grow it, as long as those fundamentals are there.
So I see there's one question down there. How big is your fund and team in India? And I'll let you answer that, but I'll add on to it a little bit more because I was curious, because obviously you guys have an office in Silicon Valley and you have an office in India. What do you see as, so you can talk about exactly what your office there is like, and et cetera, but do you look for different things in the different countries? I mean, how do you see the marketplaces as similar or different from each other?
Mm-hmm. Mm-hmm. Well, I'll take the front end of that, and Manu, you can chime in on the back. And we are managing a little over 150 million in our two funds. Our latest fund is a little over 100 million. It's one fund for both geographies. We really don't have a geographic mandate. We have a team in India that's the same size as Silicon Valley. There's 3 of us here, 3 partners there. We've been together, since 2007. Started in 2006. We're a startup. We're a startup venture fund in that sense, and we're in our 8th year. And we've had some, wonderful companies, and it all came out of our experience in the 15 years prior to that, back to the early 90s, backing entrepreneurs in the Indian community between here and India. And so our focus is a community focus. That's our unique, selling proposition as a venture capitalist. We have, deep and long-standing ties in the Indian communities across the globe. And we all come out of operating backgrounds in the types of companies we back, which are primarily software and digital services types of companies. And so that's that's the reason that entrepreneurs seek us out, is that level of experience and operating understanding and kind of hopefully constructive hands-on help that we try and provide. Usually we talk to our entrepreneurs to verify all that. But, the environment in India is changing dramatically, and the Indian community there has been a big contributor to the ecosystem in Silicon Valley since almost the beginning. One of our co-founding partners was the first Indian to emigrate to the U.S., get venture backing, take a company public, and and that's been going on for decades. And what's happening is that those entrepreneurs don't need to emigrate to create that value, create these interesting global companies. And now they also have a very interesting local market in India itself to address. So we're seeing a number of companies that are what we believe could be best in class out of India that are addressing the U.S. markets, competing for the markets here, and we help them. Ultimately, they will have to move here. They'll have to build their sales team here, but they have a huge cost and go-to-market advantage because they're doing their engineering in India, and they're generally able to hire really talented people much faster than you can in the environment here today in Silicon Valley. So, and then, like I say, there are other Indian entrepreneurs in Silicon Valley who are saying, gee, I see an opportunity in India to go after a new market there, to apply, what I've learned here in Silicon Valley, building startups, and go build one there. And so we also help those entrepreneurs, go back to India and build companies. So it's just it's a back and forth. It's a very fluid community.
Did you have anything else to add to that?
Yeah, I mean, just looking at overall opportunity, I mean, the type of companies we see here versus there, I mean, we don't actually seek out different types of companies. It depends on the problem that the entrepreneur is looking to solve, right? So, for example, a big thing we get attracted to is marketplaces, right? Because, it's a dual-sided network for supply and demand. And we like them because, first, we have a lot of experience having done them and know the metrics and things, but the types of problems they solve are different, right? So in the US, because there's higher disposable income, we have a company in the fashion space that sort of does that. But the same model in India may not be the right model today. Maybe 15 years from now might be a better fit for that company. But we backed a company that interested buses in India, right? So I'm buying a $10 ticket to go between cities. Having that marketplace built was far more useful and timely than a fashion marketplace in India. But but there were both marketplaces, and so we were backing entrepreneurs that were solving a real need, a real pain point. So I don't think we differentiate as per going after certain sectors or certain themes, but they emerge because that's what the entrepreneurs are finding in the market, right? And our value add is not betting whether technology or some of the pieces are the right pieces at that time, but more sort of helping the entrepreneur figure out the business model, go-to-market strategy, pricing, all the things in between, helping them become better entrepreneurs, better CEOs for that matter. We find really good people that are engineers, have that background, but need some mentoring and help to actually become the CEOs that can actually run that company well, right? So our mentoring and helping them sort of evolve is a value add that we bring in, whether it's here or in India.
What are the biggest challenges when you're advising a company either starting in India that's addressing the U.S. market, or someone who might be in the U.S. Who may be looking at India as a market? Obviously, these are two very different markets, and it helps to have experience in the one they're going to. But what are the challenges when you're crossing borders, when you're crossing languages, when you're crossing time zones? Even if there may be advantages in some ways in terms of costs or other things, what are the big challenges that you're often addressing with these entrepreneurs?
Well, I'll give you a practical example so that sort of drives it home as well. So one of our companies called Socrate, the entrepreneurs actually worked at Amazon in Seattle, right? And then they moved to India and built a company there because they saw an opportunity and an arbitrage to build a company there, right? And now they've expanded or they're expanding globally. And the first country they're looking at is the U.S., right? So now this founding team already had experience working here. The CEO is now moving here. So in that case, you have this very fluid sort of transition back and forth, right? I mean, just to sort of make the point even clearer, a lot of entrepreneurs in the Bay Area actually look at Bangalore before they would look at New York City to expand, right? 35% of companies that are headquartered in Silicon Valley have an Indian co-founder or a founder, right? So this is not sort of a niche sort of play, that we're sort of helping them go back and forth. A lot of them already have, feet on both sides. They may have run operations in India while they were, living here, and so they're going back and forth. And I think that's the entrepreneur that's really successful for us as well. Now, we've had examples of somebody who's built an enterprise level company in India and now needs a front sort of to be able to expand to the US markets. And, in that case, we're helping them hire the first GM, the first salesperson, recruiting, helping, looking at our network and expanding that out, because the biggest thing they get shot, and John, you can correct me if I'm wrong, is when they realize how expensive a salesperson could be here. They're like, well, this person's going to make 3 or 4 times more than I'm making as a CEO. Makes it very hard for you to hire that person. So I think us helping them across some of those models and acclimating them to here really helps. To
Yeah,
even institutionalize this, right? Go ahead.
yeah. I think Manu hits the right points. There are opportunities in this model, but there's certainly challenges. It's a trade-off, like so many things, right? And you know, so to mitigate some of those challenges, we can help, but we also look for teams like Manu's giving you the example of Socrati and others that have some context and experience in the U.S. if they're going to come after the U.S. market. We're reticent to work with a team that hasn't done that because there's just so many things that they need to understand, and there could be a lot of tuition paid for them to learn that, right? And there's also just the commitment and understanding of what it takes on a time zone basis and a travel basis. If you're a founder of what we call a mini multinational, right? You got to be willing to travel a lot. It's an added stress element to starting and building that company, and it's not for everybody. We do it. We're in India every 6, 8, 10 weeks ourselves. Our partners are over here. I mean, we're back and forth. We can all do video conferences like this, but in the end, you got to be face to face in our business. And so you have to have that experience and commitment. And if you don't have it, then we can help you find it. So, part of it is that, we can help identify founding members that, on either side, right? But the third model that we've talked about, the model where there's the Indian entrepreneur in India going after the U.S. market or the local market there, and then there's the entrepreneur going after the Indian market. But very commonly, and as Manu points out, 35%, a third of the startups in Silicon Valley are just basically leveraging the talent in India to go after a market here. So you have your founding team here, and you're building your engineering team in India. And we think that is an accelerating trend in the sense that now we see a lot of companies. Basically, when was the last time anybody bought technology for a straight up license price, right? We don't even buy our phones that way, right? It's all on a services contract. It's all pay as you go. And so the next step in that services model is an expectation, not just of hey, I can pay $10 a month instead of $100 a year, but what about some other real services bundled in there? And bundling in real services that involve any kind of human capital is very difficult to do from the U.S. It's just too expensive. But we have a lot of companies that are building that service capability out of India, addressing global problems. And you see this with, some obvious examples are outsourced legal services, outsourced, and those are more just arbitrage. But if you want to add a lot of high value add, to a product, for example, in manufacturing, we've got a company that's got a huge team in Pune, which is outside of Mumbai. They're a Silicon Valley company right here, and they've got blue chip customers like GM and Cisco and Delphi, and you name a manufacturer, and they're basically helping them manage their supply chain. And there's a lot of very deep ongoing work that couldn't be done here. You couldn't do this company if they didn't have the nearly 100 people they've got in India providing that back end service. So we think that it's going to be a services-based economy. Digital services is the theme that everybody's focused on, whether it's an enterprise or consumer, right? And that service delivery is not always going to be completely digital. There's going to be some analog in there. There's going to be some people involved, and companies that know how to, leverage these resources over there are going to have a big advantage.
We'll talk about the Indian marketplace. I think I saw that you guys described India as being sort of 10 years behind China in a tech way. And obviously, what's going on in China is so huge. But obviously, a lot of people, there does seem to be a ton of investment with people who have a similar idea going in. I think in the last few days, there's been the news about Flipkart raising a ton of money at a very large valuation. So there's clearly a lot of people think similarly about the potential growth that's there. When you look, and you say 10 years out, it could be as big as what China is today, which is very big. What are the challenges though to getting? What are the things that India needs to do as a whether it's a startup community or from a regulation standpoint or whatever there are, what are the big challenges that still need to be addressed to get to a place where 10 years from now you're saying, yeah, this is pretty great.
Yeah, I mean, I think you nailed this on the head, right? So a lot of the innovation and the growth is coming from the bottoms up, right? You have entrepreneurs recognizing large markets, right? Just to sort of give you some numbers for the audience to chew on as well. You have a couple 100 million smartphones and internet access in India, right? In the next 3 years, you're looking at over 600 million of these people actually getting access to the internet for the first time, right? So you have a massive audience that's coming online, and then at the tail end, you have people with access to more credit and to be able to purchase these things, right? And they're leapfrogging technology, right? I don't expect you'll ever see a Walmart or Target in the middle of Bombay or Delhi because there isn't space or real estate to do it, right? And you don't have these massive, sort of suburbs that you saw in the U.S. in the 50s and 60s, and it still happens. So they're leapfrogging, and they're going from a corner store, what you saw in the U.S. in the 40s and 50s, to straight to e-commerce, right? And so you can build large companies, and the same thing happened in China. So I don't see any differences there, and government regulations and stuff on either Chinese or Indian side is pretty backwards, right? So these things happened because you had entrepreneurs that were motivated and they could see the market and hammer through it. Now, having said that, I think there are things that the Indian government can do to get out of the way and make it easier for both creation of companies, shutting down of companies, having capital that is easier to sort of come in, not having arbitrary rules about ownership structures by foreign capital. And making it easy to actually do business, right? So, it would take 26 forms and applications to start a company in India and take 3 years to shut it down. And some of those things are being worked on where, they do want to improve the efficiency of doing these things. And then you look at the labor laws, right? India is one of the most automated factories in the world. When you look at so much labor, an Indian factory actually resembles Germany more than it resembles China in terms of automation within the factory floor. And that's because labor laws are so archaic and hard in terms of hiring and firing, or actually especially firing people, that asset owners in these factories actually prefer to automate and put the capital up front rather than having to hire and deal with labor, right? And so you need a massive sort of policy changes by the government to be able to get these things done. But in spite of all these issues, India has the same aspirations as anybody in China or the U.S. does, right? You have 1.3 billion people, and genie's out of the bag. I don't think we're ever going to be able to put it back in, right? So India is where China was in 2004, where you saw Tencent and some of these companies sort of go public. And China has never looked back, and I think India is sort of on the same heels as well, right?
Yeah, and we hope it doesn't take 10 years from here to catch up. But if we took a snapshot of where they are today, you'd say, oh, it's about the same kind of digital on-ramp, penetration of the consumer base as it was in China 10 years ago. There's 200 million or so that have access to the internet, but China, through most of that period, had to rely on deployment of fiber and wireline communication to bring more people on board. And guess what? Now it's, as Manu says, they're leapfrogging. So it's all going to be mobile phone. We don't, you don't even think about mobile first. It's just mobile only. Is really the thought of most consumer startups in India. And so in other words, they could be thought leaders in building the next generation of mobile applications globally. I mean, that's a grandiose thought, but they are really forced to think only in terms of mobile, and not even in terms of like the kind of 4G bandwidth that we're thinking about. So you get some pretty efficient engineering out of the system because they have to figure out how to make it work on a 2G flip phone still. So it's a pretty dynamic environment. I think that as you point out, there is a lot of optimism in the system. I think if you went to India today, it'd feel a lot like Silicon Valley in the entrepreneurial community, in the entrepreneurial circles, because all these challenges, the public policy issues, there's just a lot of optimism that the new government that has come in is going to change that. They've said they're going to. People believe them, and they're making bets that they're going to get out of the way. And there'll be more net neutrality and all that sort of thing. Broad-based access to the internet. And the country clearly needs it. There's so many inefficiencies that couldn't be addressed any other way. And we clearly believe it too. We've believed it since that was the thesis and why we started this firm, is that was going to be a key factor. So hopefully we're right.
There's one more question on the bottom.
Yeah, I see. So we had a question. You may have indirectly answered this, but do you suggest that entrepreneurs should take the funding while it is available, especially with talks of a bubble? And do you think that there's a bubble? So I think we talked a little bit about this earlier, but maybe we can circle back on that briefly. And is this a bubble? And what do you suggest? What's the underlying recommendation for entrepreneurs who are in this potential bubble?
Yeah. Well, bubbles take all shapes and sizes, right? You go to any kid's party and you can see that, right? For me, the bubble here, there's definitely a bubble, and I'd call it a capital bubble. Capital seeking return, it has very few choices, and the returns in the venture economy and in startup ecosystem have proven to be very attractive. So capital is chasing it, and so yeah, if you're starting a company, that's what I said up front. One of the nice things about this for an entrepreneur is that while there'll be other challenges in the trade-off here, getting capital is probably the least challenging as it's ever been. And so if you think you've got an idea with legs, you should take the capital. Should you spend it? Should you spend it crazily? I would suggest not. That was the other point I tried to make, is that it can't last forever. Interest rates go up, other forms of investment start to catch up on returns, and the capital will even out. The cycle will slow down in terms of how much capital is in the system. And so you should do rational things. The hardest part about all that is easier said than done, right? Because if the guy down the street or around the corner or across the globe is doing irrational things, and he's investing for growth, and he's scaling a sales force without understanding the economics of it, and he's just shooting the moon and hoping for the best in your market and competing with you, then you can either sit on the sidelines and let that happen and not get your market share, or you have to compete in some way. And for a startup, that's less the challenge. For the later stage companies, that's the big challenge right now, because they're all competing to scale, and not everybody's scaling very efficiently. I think if we're talking about starting a new company, it's more about that initial capital and using it wisely to find the product market fit and find a model that is scalable. And if someone wants to give you $40 million to do that, but it only takes 400,000 or 4 million, then just use the 400,000 or 4 million. And maybe you don't need any more capital for the rest of the company. Or maybe you now finally have your first big tranche of scaling capital later. The temptation, of course, is always to raise the burn rate, raise everybody's salaries, get big offices, and sign long-term contracts on real estate, all the things that, and that's why these cycles go, because not everybody can. It's all easier said than done.
So, yeah, I'll take the macroeconomic view on this, because I think John covered all the points. So you need a boom before a bust happens, right? And we are in a boom cycle, and good things come out of it. Just because it's a boom is not a negative word, right? So it actually allows entrepreneurs or people that are at the hinge working at large corporations to sort of take the chance and leave and try it, right? Because the risk is low, because you always think you can go back and work. So you need, and then what happens is Facebook goes public, Twitter, all these all employees of these companies that actually were pre-IPO all assume that they are smart and they can actually become angel investors. So you have a flood of money coming on the bottom, convincing other people to quit their jobs and be entrepreneurs, and that's all good for the ecosystem, right? And when the cycle stops, the cream will come to the top, and then you have destruction again, and that's not a bad thing. I mean, in a dynamic environment as we have in the U.S., the cycle of creation and destruction is actually a very important part of creating the companies we see, right? I mean, I worked at Google during the downturn as well, and some of the best things came out of there because you're able to then hire people as well. If you look at Facebook, all these large companies, they actually went through the early stages was down to a downturn, right? So there's good and bad on both sides. Just like in the markets, you can play puts and calls, and you can do well on both sides of the market, right? So I don't see a negative just because people equate bubbles as a bad thing.
So for entrepreneurs, the takeaway might be be
Do it
opportunistic.
now.
Yeah, be opportunistic, but also be disciplined. That's there.
Yeah. I mean, because bad times can come and it can happen very quickly, right? I mean, there's nobody can give you the crystal ball sort of saying, hey, market crashes, next month or a year from now, right? But when it happens, do you have the discipline to retrench, and do you have a model that either crashes or can you retrench back and sort of say, hey, maybe I built a team of 200 people, but now I can scale back to 25 people and I can be profitable, retrench and then build a bigger, stronger company, right? But if you have sort of completely gotten out of whack and your gross margins are negative, well then you don't have a company to run, right?
Yeah, I mean, it
Because
goes
the
back to
cheap
some
and
of the
free
things we
money is
talked
out.
about, earlier, right? That, if you think you've got the conviction that you have an insight and a product and a team that's going to be the world beater, then yeah, take the money, go build that company. Why wouldn't you? But you have to be brutally honest with yourself, right? And that's the problem in this environment. It's hard to be brutally honest. So many people are getting the money that don't have that conviction, that don't evidently have that team or that insight. There's a lot. If it's an idea that you want to flip it and have someone buy it next year, which we see a lot. A lot of people that think, oh, I can go get rich quick. I can spin something up and I can sell it for 50 or $100 million. Why couldn't I? And why shouldn't I? Everybody else seems to be. And those are the ideas that are not companies. They may not even be products. They're features. They're usually a feature of a product that you expect is going to be acquired by the guy that owns that product or owns that is the leading company there. And those are more dangerous. And that's a more calculated bet that as an entrepreneur you have to make. You say, well, I'm making a timing bet now. I'm betting that I'll be able to flip this thing and, before the capital markets or whatever aspect of the bubbles we might imagine out there pop. For us, our discipline is to try not to encourage that behavior. We're looking, like we say, if we stay focused on building companies, we can keep ourselves out of a lot of that trouble.
Okay. Well, we're coming up on an hour here, so we can probably wrap it up. Is there maybe the best thing to do? Say if there's any closing remarks you want to make, and maybe you can leave folks with each of you with sort of the one defining sort of crystal of information that you would give if an entrepreneur or a viewer came up to you and said, what's the one thing I really need to know, when I'm starting my company or I'm looking for funding or whatever it may be, what's that one little nugget that you may want to leave people with?
Well, I can start. We're venture capitalists and we think we're pretty good at it, but I think that there's a lot of people out there that make those claims. I think for the entrepreneur, the advice I have is to be, especially in this environment of choice, the entrepreneur has more choice now than ever of where to find the seed or the early stage capital. I think you got to be very patient about that and make a good choice. And you're picking a business partner, you're not just picking an investor, right? And we like to see entrepreneurs that want to check our references, talk to the entrepreneurs we worked with for the last 20 years, and really understand our staying power. And I, whether it's us or anybody, I think that, if you can, what you want to avoid is what we call the hot money, the people that may not have the fortitude to stick with you over the long haul, who are coming in the market as investors, but aren't there for the long term. I think that, again, the fundamentals of most companies, it takes a number of years to build them. And so you want to find a partner that's going to be there for a number of years with you and is comfortable with that, not pushing you to sell early and flip the company or sub-optimize your decisions. So.
My parting thoughts would be, it's all about the people. We're investing in people. You should be investing, in people, your co-founders, your first, execs or teams you bring in. If you lower your standards and you start hiring B players, they will hire C players, and that's the fastest way to sort of lose your company. So don't give up on the quality that you build, and especially initially, because that's the culture that will build a lasting company. So we focus on people, and I would encourage you to do the same as well.
Mm-hmm.
That's good, right?
And everything John said as well.
Sure.
Ditto.
Well, great. What? You guys work together or something? Yeah. This is,
yeah. Would you believe it?
Well, this is great. Well, thank you for having me. And I think you can get, I know you guys have more information on Inventus on your website, and you can find me at Forbes. Yeah, if there's anything else you guys want to say, but otherwise, thanks everyone for watching.
Yeah, I mean, if you need to follow me, my Twitter handle is @Manu, MANU. That's my first name. So, and that's it.
And thanks everybody who stayed on for the whole show. It's hopefully we'll talk to you again.